A caller recently asked Dave Ramsey if he should put money into cash value life insurance after maxing out his Roth IRA. Let's take a listen to what he had to say, then I'll give you my thoughts afterwards.
Well, whole life does not grow tax-free unless you lose money. And your basis for tax purposes in a whole life policy is the total of your premiums. So if you pay in $100,000 over a bazillion years into your whole life policy and your cash value is $90,000, you have lost $10,000. And so, of course, there's no taxation.
Okay, as a clarification, when Dave Ramsey says whole life insurance, that's a catchphrase for any type of cash value life insurance, including index universal life, which he also frequently maligns. Okay, let's begin with Ramsey's demonization of the growth capabilities of cash value life insurance. His first issue is that you're never really going to break even in these products. You can put money in over a bazillion years, and you'll still be underwater. Patently untrue. Take index universal life, for example. If structured properly, meaning you're getting as little death benefit as the IRS requires of you, and you're stuffing as much money into it as the IRS allows, you can break even in as little as 5 to 7 years. How is this possible? Because an IUL with the right carrier has historical track records of between 6 and 8% gross of fees or 5 to 7% net of fees. All that without taking any more stock market risks than what you're accustomed to taking in your savings account. Sure, you can do a lot better in the stock market, but the IUL is not a stock market alternative. It's a bond alternative. Reach into your portfolio, remove the bonds, and replace them with IUL, and you'll increase your return, lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. Next, Ramsey addresses whether the growth on your money, if you ever were to experience that, is not really tax-free. Let's listen.
Or you can borrow your own money and pay them an interest rate to borrow your own money. And by the way, 100% of the time, borrowed money is not taxable. So whole life in and of itself does not grow tax-free. That is a falsehood. Mm-hmm. If it actually made money and you took the money out, it would be taxable.
Okay, in short, your money will never grow. But if it did, the only way to get money out tax-free is by way of a loan. And all loans are tax-free, so that doesn't really make life insurance all that special. Okay, Ramsey is really painting a terrible picture here, isn't he? The only problem is, as usual, he isn't giving you the entire story. He has made strategic omissions. For example, while it is true with an IUL that you will pay a rate of interest when you take a loan, let's call it 3%, some companies will credit that 3% right back to your cash value. So they charge you 3%, then they credit that 3% right back to you. So the net result is you have a tax-free and a cost-free transaction. It's not all that different than a distribution from a Roth IRA. You asked for, say, $10,000, you got $10,000, your cash value went down by $10,000, and you didn't have to pay tax on it. Let's press on.
But they never do because they suck so bad. The rate of return is horrendous, and the fees are so high. And so, no, I would never consider that as an option. Instead, I would, listen, dude, if you put your money in a fruit jar as your side investment after you maxed out a Roth, you're going to end up with more money than you will screwing around with a whole life policy because they lose money.
Again, if we're talking IUL here, you break even after 5 to 7 years. You average net rates of return of between 5 and 7%, and you can actually access your money 100% tax-free by way of a net cost-free loan. Elsewhere, Ramsey has said, quote, 100% of cash value life insurance sucks 100% of the time. The only people who get it are either easy dupes or they just haven't researched it enough. If you have cash value life insurance, you are to surrender it immediately and buy a term insurance policy through Zander Insurance, close quote, who, by the way, is a huge sponsor of his program. If you take Dave Ramsey's assertions about cash value life insurance at face value, you can see how these statements might give you pause before entering into the contract. But when you dig just below the surface of his statements, particularly when it comes to an IUL through a top-level carrier, you see that Ramsey's characterizations couldn't be more factually off base. Now, is cash value life insurance like whole life or IUL for everyone? Absolutely not. There are very specific and prescribed contexts in which they make sense. But when you listen to Dave Ramsey's frequent diatribes against cash value life insurance, don't you get the feeling that he just isn't telling you the whole story? If you'd like to learn what else Ramsey isn't telling you, check out my USA Today national best-selling book, The Guru Gap: How America's Financial Gurus Are Leading You Astray and How to Get Back on Track. You can purchase it on Amazon or wherever you buy books. By the way, in the next 10 years, I'm looking to put 1 million Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davidmcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll do my very best to respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.